Is it?
Thank you, Mr. Chairman and Mr. Secretary. Mr. Secretary, in your comments, you talked about the continued wind down of Fannie and Freddie's investment portfolios at a rate of no less than 10% annually. Some of that is wind down. Some of that, however, will be selling into the marketplace, which we've discussed before. What has been done in that regard thus far, and does this mean that we're going to be selling off 10% of Fannie and Freddie's portfolios into the marketplace in the balance of this year?
I can't tell you precisely the mix between a natural runoff and what would be an actual sale, but I can say that based on the experience so far, the market's been able to absorb the wind down on that pace. But happy to provide more details to you on that. And you can't be certain how the market's going to evolve in the future, but we think that it's reasonable and prudent to adhere to that path.
And you do expect to be selling, obviously with interest rates where they are, some of this can be sold off at a profit.
I want to be careful how I say that. I can say for the Treasury portfolio that will be the case.
Okay, all right. I suspect you know this, but there's not, in terms of the three options of where we go in the future, there's not unanimity of thought here on either side of the aisle. So I will confess that I am a public utility model type guy. Now, it sounds like you don't particularly like that term, so I guess it falls within option 3 in your set of options. Let's call it instead something where there is a guarantee or federal reinsurance that is available to multiple entities that is, as you suggested, explicit and limited, as opposed to the Fannie and Freddie model where the guarantee was implicit and unlimited. What is your reaction to that sort of model going forward?
I think it has a lot of merit. I think it has a lot of merit, but again, you want to be careful to design in a way to make sure you meet those tests. And again, I want to emphasize something that Mr. Henseling suggested earlier, which is that if you're going to have the government provide a guarantee through FHA or through some hybrid mechanism like you described, what you need to make sure that it is priced to cover risk of loss. The taxpayer is substantially ahead, the taxpayer is behind a bunch of private capital in that context, not ahead of it. And you want to make sure that you leave politics out of the setting of the basic fee. That's very important. And you can't create a system that's going to be vulnerable to your successors and lobbyists, other stakeholders, trying to put pressure to underprice those guarantees in the future.
I couldn't agree with you more on those points. If we don't do something like that, if we do something that has less involvement, my concern, the housing market is such a huge portion of the economy, as we witnessed in 2008. If left without some stability to it provided by the government, you'll have vicissitudes as banks, which they often do in other ends. They get all excited and all of a sudden they want to loan everybody in the world money for a house, and then after they have some losses, all of a sudden they don't want to loan anybody for a house. And this happens in other segments of the economy, but it affects those segments, makes them very volatile, but it doesn't have that huge an effect on the overall economy because they're not that big. But the housing market is so big that if we subject it to those vicissitudes, I'm afraid that we will have some significant additional volatility in the overall economy. You agree?
I think there is that risk, and you stated very well, and that's why I want to emphasize over and over again that when you look at alternative models that look like they have a more of what people say a private character to it, a more purely private character to it, most of those systems out there involve banks holding all of that risk. And as you know, the history of financial crises is largely a history of banks and real estate together. And the government ultimately is there. It's just behind the banks with this implicit support that they don't charge for, still leaves the taxpayer exposed to loss. So again, the really difficult challenge is to try to make sure you have a system where you have more conservative standards for underwriting. Homeowners hold more equity in their homes. Banks hold more capital against risk.
The
government's role is very limited.
Let me sneak in one final question here. You talked about that we may have higher downs and that will require higher downs and that there may be higher costs for mortgages for moderate income people, et cetera. Can we reconcile that with also for taking rentals aside, but for low-income people, then saying, oh, no, we're going to have modest downs and perhaps no more increase? In other words, how can we tell moderate-income people it's going to be harder to buy a house and lower-income people it's going to be easier?
Let him answer the question.
Well, excellent question. Again, that's the kind of judgment Congress has to make. But my own view is that there is a good public policy case for the government providing some assistance for low and moderate income Americans so they can afford that first house. I'd want to try to preserve that, carefully designed in any system going forward. But that objective is consistent with returning our system to a system where the private market plays the major role in housing finance. And if we get better oversight, better capital requirements, better underwriting standards, we'll have a more stable system.
Thank you. Ms. Capuano?